Hello and welcome back to What Changes. I am May, and today we are looking at a silver market that is currently standing at an incredibly fragile precipice. We are balancing on an edge where generational wealth is typically either meticulously created or violently and painfully lost. We are not looking at a random fluctuation today, nor are we looking at a market reacting blindly to the passing news cycle. We are looking at a highly structured, highly deliberate sequence of market behavior that is demanding your absolute attention right now. For weeks, we have navigated a deeply complex and often deceptive financial landscape, and at this exact moment, the market is presenting us with a defining test of discipline. This is precisely the kind of environment where retail investors, driven blindly by the fear of missing out or the sheer terror of sudden portfolio drops, make their most devastating and irreversible mistakes. But here at What Changes, we are not going to operate on fear, and we are certainly not going to operate on blind hope. We are going to operate strictly on cold, calculated probabilities. The recent price action has delivered exactly what our structural models anticipated, but the trapdoor beneath us is still very much open, and the ceiling above us is heavier than most market participants realize. If you have capital exposed to silver right now, or if you are waiting anxiously on the sidelines for the perfect moment to deploy your hard-earned cash, you need to deeply understand the invisible architecture of these current price levels before you make your next move. Let us strip away the daily noise, silence the sensational headlines, and look precisely at what has unfolded since the prominent swing high we experienced in early February. From that specific peak, we have witnessed a clear, undeniable, and highly structured five-stage decline. This was not an accident, nor was it a random sell-off triggered by unforeseen events. It was the natural, mathematical exhaustion of buyers following a deeply deceptive and emotionally manipulative rally. Just prior to this drop, we saw a perfectly executed three-stage upward move that gave many retail participants a dangerously false sense of security. That specific rally hit its structural target with absolute textbook precision, fulfilling a mathematical extension of its upward momentum before immediately and violently failing. When a market moves with that level of mechanical perfection, it creates a massive psychological trap for the unprepared. Retail investors look at that sudden burst of strength, their inherent confirmation bias kicks into absolute overdrive, and they desperately convince themselves that a massive new bull run has officially begun. They ignore the broader structural context because they deeply want to believe their long positions are permanently safe and that they have outsmarted the market. But as professionals analyzing the true architecture of price, we understood that this upward move was likely just a temporary corrective bounce, a brief and dangerous reprieve before gravity took control once again. And right on schedule, the market rolled over, leaving highly emotional traders trapped at the very top of the structure while the calculated money quietly stepped aside and secured their capital. This brings us to a crucial, unavoidable discussion about the psychology of investing and the incredibly destructive nature of ego in the financial markets. It is exceptionally easy to let confirmation bias dictate your financial actions, especially when dealing with an asset as highly charged as silver. When you hold a heavy position, your brain actively and subconsciously searches for any piece of obscure information that validates your bullish bias, while aggressively filtering out the blinding warning signs flashing right in front of you. When the market starts to turn against them, the emotional trader simply freezes in disbelief. They hold on to losing positions out of sheer pride, praying silently for a miraculous reversal rather than respecting the structured levels that dictate market reality. This is exactly how small, highly manageable paper losses transform into catastrophic, permanent portfolio damage. Trading and investing are not about being a prophet, and anyone on the internet who claims to have a crystal ball predicting the exact top or bottom is actively deceiving you. Ego demands absolute certainty, but the market only ever offers us probabilities. As calm, analytical strategists, we must suppress the primal human urge to predict the future and instead focus entirely on reacting intelligently to the present moment. We apply a strict probabilistic framework, mapping out the highest likelihood scenarios and preparing for them with absolute, unwavering discipline. The precise moment you begin to believe you are smarter than the market is the exact moment the market will violently humble you. Before we dive into the specific critical price levels that will dictate the next major move in silver, I want to take a brief moment to invite you to join our growing community. If you want to stay ahead of these rapid structural shifts and receive real-time insights, I highly encourage you to join our free Telegram channel and follow us on X. The direct links are listed in the YouTube description below. Additionally, I have included a link in the description to a specific book recommendation that fundamentally breaks down the exact market psychology and disciplined mindset we are discussing today. It is required reading for anyone serious about separating their emotions from their capital. Now, let us return to the charts and dissect the exact architecture of the danger zone directly above us. Right now, our primary analytical focus must be on the heavy, oppressive ceiling of resistance that has formed directly above the current price action. Following the recent sequence of structural declines, a formidable barrier has been established exactly between $88.22 and $94. I need you to write those specific numbers down and burn them into your mind for your visual tracking as you navigate the coming weeks. The zone between $88.22 and $94 is not just a passing hurdle, it is an iron wall of institutional supply. If we see a sudden aggressive bounce in the coming days, the retail crowd will immediately cheer, assuming the worst of the correction is over and the bull market has forcefully resumed. But until the price decisively breaks, and more importantly, holds above that $94 threshold, any upward movement is highly suspect and extremely vulnerable to a violent downside rejection. We must actively treat any rally into that $88.22 to $94 window as a severe danger zone, a high probability area where large sellers are patiently waiting to unload their heavy positions and drive the price right back down. A definitive volume-backed breakout above $94 would logically force us to re-evaluate our primary downside expectations, but based on the current market architecture, that ceiling remains fully intact, incredibly heavy, and extremely hostile to new buyers. On the downside, we must critically evaluate the structural flaws that are currently keeping this market from a much deeper, more aggressive capitulation. The initial shock of the recent drop was absorbed precisely at a critical mathematical support level of $82.82. The fact that the market reacted exactly at $82.82 is not a lucky coincidence. It is the mathematical reality of how modern algorithmically driven markets function. But a floor is only strong until it is tested too many times by relentless selling pressure. If the downward momentum resumes and that $82.82 level suffers a definitive breakdown, the structural trapdoor swings wide open and the descent could become incredibly rapid. Below that initial floor, the next defensive lines are scattered, weak, and highly precarious. We are looking at potential temporary support resting at $78.37, followed closely by an even deeper, more fragile level at $75. If the downward acceleration breaks through these minor speed bumps and true panic sets in among the retail crowd, we could easily see a vicious, cascading flush all the way down to the $69 to $70 area. That low $70 region represents a massive psychological and structural battleground for the long-term future of the silver market. In our primary highest probability scenario, what we map out as our most likely structural outcome, this current market architecture suggests we could ultimately see a sequence of downward moves, pushing prices all the way into the low 50s. Let the gravity of that statement sink in for a moment. A systematic breakdown of these sequential flaws could result in a devastating, drawn-out bleed into the low 50s, trapping anyone who blindly bought the early February highs out of sheer impatience and greed. However, markets rarely move in straight, uninterrupted lines. We are constantly monitoring relational probabilities, meaning we adapt dynamically as new microstructures emerge on the chart. There is a very real alternative scenario, a highly complex, deeply frustrating corrective phase where the market essentially chops back and forth in a brutal sideways grind. In this scenario, the market would violently bounce between these specific floors and ceilings, ruthlessly testing the patience of everyone involved before finally deciding on a definitive macroeconomic direction. In this complex, grinding scenario, we might see a sharp, aggressive bounce from the $70 area, offering a brief window of false hope before the next sequence begins. Both of these highly dramatic scenarios, the deep capitulation to the low 50s or the brutal sideways grind, demand one thing above all else: absolute, unwavering patience. To survive in an environment this treacherous, a professional strategist must deliberately structure their exposure to withstand intense volatility without triggering their own emotional panic. This brings us to a vital lesson on how the smart money operates and how you can separate yourself from the emotional herd. This is where the strategic division between long-term core holdings and short-term tactical positioning becomes the ultimate financial weapon. Think of core, physical, or long-term investment positions as the untouchable foundation of a wealth-building strategy. A disciplined professional does not touch them, does not panic sell them during routine market corrections, and certainly does not let day-to-day chart volatility shake their foundational conviction in the overarching economic cycle. However, to aggressively protect the psychological and financial integrity of that long-term stance, a professional employs precise, short-term tactical hedges. When the silver price rallies blindly into a massive resistance zone, exactly like the ceiling we identified between $88.22 and $94, that is precisely where a calculated strategist deploys a short-term protective hedge. By initiating an inverse position right at the ceiling, they are essentially buying vital insurance against the high-probability downward rejection. If the market collapses back toward the $70 floor or worse, the long-term holdings might temporarily decrease in paper value, but the short-term hedge is actively generating hard profit. This mechanism entirely neutralizes emotional stress and provides fresh, liquid capital to deploy at those significantly lower prices. And if the market stages a miraculous, unexpected breakout above $94, the strategist simply cuts the hedge for a minimal, highly managed loss, while their core wealth continues to expand rapidly with the new bull run. This dual-layered approach completely eliminates the desperate emotional guesswork that systematically destroys amateur investors. You are no longer praying for a direction. You are mathematically and strategically prepared to capitalize on either outcome. The brutal reality of the current silver market is that we are trapped in what professionals know to be the most vicious and unpredictable phase of market behavior, the complex corrective phase. These phases are designed by their very nature to be as psychologically difficult, misleading, and financially draining as possible. They exist for one primary reason: to chop up over-leveraged day traders, to ruthlessly test the resolve of long-term holders, and to organically transfer wealth from the deeply impatient to the fiercely disciplined. When you look at the recent price action, you might feel an overwhelming, almost biological urge to anticipate the absolute bottom. You might want to be the hero who catches the exact low before a legendary reversal makes headlines. You must suppress that urge immediately. True professionals are perfectly content to sit on the sidelines, vigorously protect their capital, and wait for the market to explicitly show its hand. If the microstructures begin to flash distinct warning signs that our primary downward target in the low 50s is being structurally invalidated, the probabilities will shift, and a disciplined strategist will adapt instantly. Loyalty must be to the data, to the structured levels, and never to a personal ego or a stubborn bias. We will meticulously watch how the price interacts with the current support. We will watch the secondary reaction at $78.37, and we will wait patiently to see if the ultimate floor around $69 to $70 can withstand the crushing institutional pressure. Until the market provides a clear, undeniable structural confirmation of a reversal, holding cash is not a missed opportunity. It is a highly active, incredibly strategic position. In closing, I want to formally remind you of the core philosophy here at What Changes. True, generational wealth in the financial markets is never built by frantically reacting to every minor fluctuation, nor is it built by trying to blindly outsmart massive algorithmic trading systems. It is built through cold, calculated, relentless discipline. It is built by clearly identifying the structural ceilings where risk is paramount, and patiently waiting for the structural flaws where true asymmetric opportunity eventually presents itself. Right now, the overarching probabilities are leaning heavily toward further turbulence, and the entire burden of proof rests squarely on the buyers to prove they can reclaim that critical $94 ceiling. Let the emotional retail traders fight over the dangerous, highly volatile scraps in the middle. Let them succumb to their inherent confirmation bias and continually average down into a falling knife. We will remain exceptionally calm, we will remain deeply analytical, and we will ruthlessly protect our capital until the mathematical probabilities align perfectly in our favor. Do not let your ego dictate your financial future. Stay incredibly patient, aggressively respect the price levels we outlined today, and unconditionally trust the process of probability over prediction. Once again, please make sure to join our Telegram channel and follow us on X using the links in the description so we can navigate these volatile waters together. And do not forget to check out the book recommendation below to bulletproof your trading psychology. I am May. This is what changes, and I will be tracking every single development closely to update you the exact moment the architecture of this market evolves. Stay disciplined, stay grounded, and thank you for watching.